All right. All right. Rob, you're looking very Christmassy today. You got your tree up behind you and it's all
I
decorated.
know. Well, so do you.
Well, mine's not decorated though. It's just a tree.
Isn't there a song on the
Those
old one
lights.
about a Christmas tree?
It does have lights. Yeah, you're kind of missing the theme, Chris, for sure. But you're in an office, so
We do.
it
We
makes
have
it
one out in our kind of our main atrium of our office suite, so that's got to count for something.
okay. That counts for something, I guess.
A
So
real tree or artificial tree?
A pretend tree. It's an I wish I was a tree. It's about 5 feet tall.
all right,
Is that
should we
like
get into the debate of real versus fake trees? Like, are fake trees really Christmas trees?
They are. They absolutely are. If you believe, Melissa, they are.
Okay, okay.
what's the name of that meat?
Beyond Beyond Meat.
Beyond meat. So you have Beyond Tree.
Ours is a Beyond a Christmas tree.
Okay. Yeah, I hear you. I need the smell too. I get it. I got allergic to trees over time, and so our house is full of unfortunately fake Christmas trees, but I love the smell.
You both are dressed very dapper, by the way. I'm trying to support my team here.
Yeah.
Um,
Well, you had a big win this past week.
we had a very fun win on Saturday. Actually, I thought it'd be kind of fun to sort of conference in Rich Swerbinski just to talk about the Michigan Ohio State game, but I thought that might be a little excessively dirty. So we'll
Yeah,
on that, but might be
yeah,
back
he might get
for
offended.
championship coming up too. Your Clemson Tigers have come on strong, Melissa, since a little bit of a rough start.
They did. Yep.
You guys aren't used to not being in the championship game, but making a good comeback.
We're gonna make a bowl this year, which I feel pretty good about considering. So we got a young team, and we got a couple good years ahead of us. I'm excited. Just getting going.
Can't be on top every year, right?
Well, we were for quite some time, my friend. All right. Well, you got comments going about Georgia Bulldogs. Yep, go dogs. Okay, Carl. I'll take that one.
I should really get on the bandwagon for this college sports stuff.
Yep. I could talk about college sports all day, but we probably should talk about some mortgage. Y'all want to talk about some mortgage?
No, I don't. I want to talk about the theme
Okay.
of the next couple weeks of TMC, right?
Yes. Can we talk about that for a little bit?
Sure.
Okay. Did you have something in mind, or do you want me to roll with it?
I have some show and tell.
Oh, some show and tell. I want to see.
Well, Christmas typically for many people means presents.
Yeah.
So I was one of those kids who never, ever threw away anything.
Oh my gosh, that's such a fun game. Does everybody remember that? Oh my gosh, I love it.
Oh, wait, there's more.
Oh, there's more. Okay.
Let's see if you remember this one.
I don't remember that one.
No, I don't.
This caused a lot of fights. You know, you draw cards, and when you get a certain card, you hit the lever,
Okay.
and then boom, and then whoever hits it last is out.
All
and
right,
then
it's just Chris and I that everybody in the chat is saying they remember those. Oh, Mousetrap. My kids have that one.
Oh yeah.
they still make this.
Yeah. They do. It's a fantastic game.
Now it's digital.
There you go.
If you play it on your cell phone.
I've got a whole closet of these.
I have a whole room. We have a whole like game room. We love board games. That's fantastic.
Mousetrap, remember Mousetrap? Anyway, I wanted to ask Chris. Chris, you are a expert in capital markets.
Am I being set up?
No.
Does everybody know who Chris is? Can we do an intro?
Chris, I mean, when people think Vice Capital, they think Chris Bennett. When they think Chris Bennett, they think Vice Capital.
That is very true.
All right. Chris, I chose to drink, I'm drinking a hard cider out of this today.
The Wells Fargo mug.
What do you think the odds are that Now, this is a serious question. What do you think the odds are that after the fallout from this huge retraction, the volumes and margins and so forth, what do you think the odds are that next year Wells Fargo bank management says, let's get back into correspondent?
That's a good question.
It is a question.
I got to put it below 50%. I think Wells Fargo's decision was a little more big picture strategic about how big they want to be and how they want to be in the mortgage space and how they want to allocate resources. It's very competitive now. Back in 10 years ago, they were one of the few big time participants in that space, and they got some nice margins out of it. They got a lot of loans. They were a great partner to work with. I personally don't see them. I think it'd be great if they did. I don't know that I see them changing course and deciding to really get back into that space. That's me. What do you think, Rob?
I'd put the odds at less than 10%. Mark there has a CRA comment about, maybe they get back into it for that. I think they may get enough, they may satisfy their appetite enough through their branch network on the CRA stuff. But the bank management, a week or 2 or 3 ago, they cut off home equity loans. In fact, I noted that in my commentary that, hey, you look at the Wells Fargo website, HELOC, it says product not available at this time. And so what people need to understand about banks is, and I'm sure a lot of people on this call understand, banks and bank management have very specific goals, specific returns on income, return on asset, portfolio allocation, and so forth. They have a lot of metrics that they use when putting out product lines. And for them to cut off correspondent, I mean, they were, as Chris, as you know, as people on the call know, they were like the gold standard. I mean, they were there through thick and thin. I mean, they were buying loans when others came and went. And people liked their sales staff. Sales management was very experienced. Now they're all doing different things, obviously, but I don't see management all of a sudden saying, "Hey, we could use some more servicing assets,"
right?
For example.
And we're happy to pay through the nose for it. I don't see that happening either.
No.
Yeah.
And that's what you have to, especially that kind of correspondent, you have to pay through the nose to get whatever you're going to get.
Yeah. Especially right now. I agree with Mark, though, that they might consider it just for the component of CRA.
Yep. If they can't get enough through conventional means.
Yep. Absolutely.
Yeah. It's easier just to call up, MIAC or Phoenix Capital or somebody and buy a bunch of servicing. Anyway.
Yep.
Anyway, that was the trick question that I wanted to lead off with.
You're starting off strong today.
I liked it. I feared much worse than that, Rob.
It's a hard cider that's in this cup.
It's the hard cider. Okay. Well, let's talk a little bit about conforming loan limits, right? It's been a big week to talk about that. It's been a big, conforming loan limits have grown a lot over, the last, 10, 20 years. I mean, we've seen, I think 110% increase. But we've only seen about 60-ish% increase in income. So, I mean, is there something going on with FHFA strategy just being different? I mean, obviously affordability is an issue. We've talked about that for a long time. But is there something else just from a strategic perspective that FHFA is looking at that's really driving their decisions to increase the loan amounts at a completely different rate than where income is increasing?
I think from my perspective, it wouldn't be so much of a FHFA deciding to do X, but just saying these are, we're not going to change the way in which we do things, which is we look at, here's how we calculate average home prices. Here's the percentage we use. Therefore, here's the number. And just being really reflective of home prices overall having increased significantly more substantially than nominal wages. And I think you look back and you can actually express it graphically and look at over time. All right, here's incomes, here's house prices as a percentage of incomes. And usually, when we got really kind of out of hand, it was 2006, 2007, and it was fueled by a lot of stuff that, we all know very well about, most of us anyway. Came back down, dipped below, and then ratcheted back up. But in this case, it's not a case of, silly mortgage practices, giving, what is it, fog and mirror loans, whatever we used to call those. But just, I kind of thought earlier in this year, this has to normalize, right? We at least doesn't mean housing prices have to come down, but we need to have nominal wages catch up with that. But the inventory issue is just inventory is so tight that it doesn't matter what's happening with demand. It's all seems to be very supply dominated to me anyway. So it feels unsustainable, but yet it is. And I don't know when that's going to change.
Yeah, I don't either.
Like that.
Go ahead, Rob.
It's like the road runner in the cartoons that just keeps running like in air, and the coyote comes out and then realizes, wait a minute, I can't run in the air, and plummets. But I'm with you, Chris. I mean, you look at the demographics, the demand for housing is there, and basically to sum up for people who are like scratching their heads saying, what the heck, Melissa, I forget what time frame you looked at.
It's 20 years.
In terms of
20 years.
Yeah.
20 years. So wages have gone up 50% or whatever, really roughly, and housing values have gone up more than 100%, which means it's more important to have a job. I should say more important to have a house than a job. But if you look at the demographics, Chris, I agree. People want to go out and grab these headlines, housing crash imminent or foreclosure wave coming. And you just scratch your head and say, what the heck? There's plenty of equity.
There is.
Every borrower out there has the ability to repay.
Yep.
And the demographics just makes no sense. Some of these headlines. So
I think one of the big causes of it is Chris Maloney, who's a great analyst with BOK. He expresses this graphically really well. He shows every decade, here's the number of new homes we built. And every decade, it's about the same, 50s, 60s, 70s, 80s. When you have this time period, though, right when the financial crisis began, 2007, we had this chunk from 2007 to about 2014 or 2015, where we built only literally 1/2 of the normal amount of housing stock. And it's not like we had these gigantic shifts up and down in population. So this shortage, this kind of almost like lost almost decade of home building that's now recovered, but there's a really big hangover from it. Even if we have, I don't know, 3% or 4% less housing, more housing that's out there, we don't have that huge supply squeeze. We don't have that intense pressure that, kind of like producing oil. You can't just snap your fingers or make some changes and, all right, hey, next month we've corrected that supply imbalance. These things happen very slowly over long periods of time. And I don't see itself, changing anytime soon, unfortunately.
I do. It takes 3 years from undeveloped land to having, a neighborhood that you can market. It's an extensive process. For sure. There's, I almost wonder, there is a lot of conversations around commercial real estate right now. We don't have to dig too much into that because a lot of our world is residential, obviously, but I really wonder the COVID shift, this kind of work from home flexibility that a lot of our members are dealing with on a regular basis, a lot of our industry is dealing with on a regular basis, really means that everybody's pulling, all those people that want to work from home are now, pulling out of the commercial real estate space. And, inventory is such a challenge for, a lot of markets for a lot of reasons you just talked about. And I just start to wonder, is there a space, where we could shorten that cycle and fill a little bit of the gap, even though it is very complex because commercial, building is very different from residential, but at least do some conversions in apartments or condos for some of that office space. I don't know. What do you guys think?
It seems like you almost have to strip it down to the studs, don't you? You're going from, you got 2 gigantic bathrooms on a floor to suddenly now that's 8 different housing units and 8 different, subsets of everything. Certainly seems cheaper than having to go get a permit to build a whole brand new residential subdivision, right? So it's got to be easier, but I know we first all talked about that when, the lockdowns were happening. It's like, oh yeah, it's easy. Just change all that into housing. It works out great, right?
Yeah, I'm sure.
Yeah, no easy solution.
No
easy solution.
But especially it's a doable one with high property value areas, especially, right?
Yeah.
You also have Chris, you know about this. the whether or not the investors will want collateral backed by like a conversion. And I think they probably would at some point. But what do you, I mean, you have your finger on the pulse of what investors want right now, whether it's, I mean, what are investors looking for? Because, and maybe you could elaborate leading up to that answer, you know, the traditional spread between a 10-year treasury, which I will argue is not really applicable to mortgages to some extent, but I use it anyway. But the treasuries versus mortgages and how that spread and why that spread is widened out. And do you see that spread coming back in? So maybe you could start with the basics.
And that's really been it's been the big news, especially as of late, right? We've had, you know, you look at our bond market going back to the bond market seems to, it's kind of the nature of all markets. It really charges too forward in one direction. People get way too ahead of themselves. And then have to peel way back, right? And then the sort of the bottom falls out of everything. Was it only 6 months ago we were 3.5% on the 10-year treasury, right? We're talking about Fed cuts and banking crisis and all this stuff. And the Fed, who really does not like the bond market leading the way, right? Came out and through a series of all this hawkish talk said, you're wrong. We're not easing. We don't care if there's a recession. We don't think there will be, but even if there is, we don't care. And in a period of 5 months, we shoot the 10-year treasury from 3.5 to 5, right? We get to the case, again, the nature of markets where nobody wants to buy bonds to save their lives. I kind of call the recent rally that we've had here in bonds the FOMO rally, fear of missing out rally. We had all these money managers that are waiting. They're like, well, yields are 4.5%, 4.75%. I've been waiting for 2 years to buy bonds at these levels, but every bond I've ever bought is underwater. Every time I buy a bond, tomorrow it's underwater, next month it's underwater. So much I just torpedoed my year. I'm not going to catch a falling knife. I gotta wait for somebody else to catch this, and then I'll pick it up out of their shattered hand and I'll jump in there. And I think one of the reasons this rally has been so quick is this fear of missing out of, oh God, I've been waiting for yields to get to 4.5 to 5%. I can buy a Fannie 6.5 security for par. And I better do it right now or I'm going to miss out on the whole entire move. And to your point about those spreads of mortgages over treasuries, you're right, they'd widened out a lot. And I agree with you. I don't like defining things in terms of mortgages versus the 10-year. I like to kind of look at a basket of a lot of 5-year treasuries because mortgages on average last about 5 years, 5 and 10-year spread. And that went from kind of the historical 1% over, blew out all the way so that about maybe 2 months ago, 6 weeks ago, we were at 200 basis points in yield over comparable treasuries, huge spread. And now really in the last 5 weeks, we've brought that back from 2% all the way to 1.5%. So still a little higher than what we had historically, but I think what a lot of participants and what investors in the market, we talk about investors in the mortgage-backed securities, we're looking for is, I need a sign of stability. I need a sign that the Fed is done hiking. I need a sign that every bond that I buy isn't going to just turn around and punch me in the face the next week. And I think we finally are at that point, and it's happened pretty violently. Even though the day-to-day isn't all that violent, you look at a month-long move and, having a 10-year treasury go from 3.5 to 5% and back down to 4.25 in a span of, we got what mortgage rates have gone down over 100 basis points in 5 or 6 weeks. Those are huge moves.
Yeah. Well,
it feels like the worst is behind us.
A lot of people think that. Lawrence Yun, the National Association of Realtor Economists, thinks that the highest mortgage rates are behind us, which is nice. Now, if rates, it's fine to have rates cooperate. Now all we need is some inventory, right? But I think the question that I'm often asked is why, and I'll chime in here, answer my own question, but why are mortgage rates higher than treasury rates? And Chris, correct me if I'm wrong, but I've always said the two basic reasons are credit risk and prepayment risk. You don't have prepayment risk or credit risk with treasury securities. You do with mortgages. And so investors want a premium over treasury rates for those two primary reasons. Chris, what happened in March with the bank failures and the banks having to sell mortgage-backed security portfolios at a loss. I mean, every to your point from 5 or 10 minutes ago, every security that's issued at a lower rate is going to be underwater when rates go up. Everything.
Yep.
It's just a matter of if you have to sell or not. I mean, maybe I have some municipal bonds that I bought at lower rates that are now underwater. What am I going to do? I don't have to sell them. So plus I don't even have really a balance sheet that I have to mark to market or anything. But do you see that risk premium, or I should say the government coming in, making those banks sell, or the banks having to sell mortgage-backed securities in order to fund the depositors and so on, that happened back in March? Is that still having ramifications in terms of mortgage pricing now?
I think that's a really, really good point you bring up. I think the market actually absorbed it better than most people thought. Because in the end, while these are things like Fannie 2s and 2.5 and Ginnie 3s, you're buying them if you're an investor at prices at 82 or 85. You're kind of you're wanting to go put up scary haunted house stuff around people's houses, hoping that they'll get scared to move so you can get paid back at par. I was actually, I thought there would be bigger headwinds from all those sales hitting the market. 100 billion here, another 50 billion there. I thought the market absorbed it pretty well, because it's also occurring during a time of what you could kind of really say is quantitative tightening, right? The Fed not only not buying mortgage-backed securities, but letting it run off their balance sheet. I don't know if we'll have a whole lot of those more sales ahead of us. So I don't think those will end up being further headwinds. I think the market absorbed it pretty well. I think in terms of those spreads of mortgages over treasury, you explained that very well, I think, to everybody too. What the market needs is some stability. And even though, again, we're making some pretty big moves, feeling like the Fed tightening cycle is behind us, no matter what comes out in speeches, being able to have a case where mortgages and bonds of all kinds don't just get punched in the face every week, I think that bodes well going forward. We really have, if you look at the month of November 30th, probably notwithstanding, bonds overall, so not treasuries, mortgages, municipals, corporates, if you look at the whole universe of bonds, it was actually the best month for bonds since the 1980s. So when buyers came in, they came in force. Fear of missing out.
Oh.
Interesting. Very interesting. Hey, as a quick aside, another quick aside, I'm full of quick asides today, including my mousetrap game. When somebody asks you, hey, I know, so I have a certain level of knowledge about the capital markets and about secondary marketing. What do you think is a good primer, a good book for somebody to ask for Christmas in terms of the secondary markets?
It's funny. There's a lot of different resources that are out there. A lot of them they're a video here, they're a white paper there. The only real great book that I've seen, I recommended, and I've actually bought and given to other people in the past. It might be out of print, actually written by one of your colleagues, called Demystifying Mandatory. I apologize for blanking on her name.
Jennifer Fortier.
Thank you, Jennifer Fortier. Of all the things, there's a lot of great information out there, and things always change. The environment changes from year to year. So there's some of the things that are a little dated there, but the concepts in the book aren't at all. And I really thought, if there's anybody who you point to and say, this person wrote the book on that, I think it's Jennifer's book. Again, I don't know if it's still in print or not. I think the last couple of times I had to buy one for somebody that they were a new client coming on, and they were asking me, and I think it cost me $100 to buy the book. So maybe she wants to do a republication of it. But
I actually happen to have this book on my desk, which is really funny right now.
Yeah.
But this is the book for everybody.
That's the book.
Somebody put in the chat, that they wanted to know what the book was. So it just happens to be.
You have Demystifying Mandatory, and I've got, Hi Ho Cheerio.
I know that says a lot, my friend.
And swear to God, for everybody watching, the three of us didn't talk about this before. This actually is all. You happen to have Melissa the book on your desk. Nope.
I just happen to have it there. That's so funny.
That's
my
cool.
gosh. Okay, well, you talked a little bit, Chris, about Fed funds rate, and kind of that being a pivotal point to people seeing kind of stability in the marketplace. Where do you think we're going from here? Obviously there's a lot of conversations around 2024 and
the market's changed its mind pretty quickly, hasn't it?
I'm sorry, say that again.
The market's changed its mind pretty quickly, hasn't it?
It has. Yep. It has changed really quickly. Where do you sit in the midst of all of that?
I don't know that I'm drinking the Kool-Aid necessarily. I think the market has a tendency to get ahead of itself. I think that happened in March, April, and May of this year when all these rate cuts are getting priced in and we have a 10-year yield at 350. The market, I think as of today, the market's priced in 125 basis points of cuts, 5 cuts in 2024. Could that happen? It could. I don't know. I think the Fed doesn't mind if growth is slower. They're happy about that. They don't mind if unemployment's a little higher. They keep, kind of beating the drum about we've come a long way, and we have, right? We've gone from 9% inflation to 3%, but their goal is 2%. And I don't see them preemptively easing, if you want to call it that. I can see, Chairman Powell gave a speech earlier today. And I think one of the reasons we saw the big rally in the bond market today is people expected him to be hawkish. And the reason is that it's what the 10-year has done. When the 10-year is up at 5%, now the Fed officials say, okay, whoa, the market's kind of doing our job for us. Let's say some nice things and try and assuage some fears. Well, since then, now we've dove down to 4.25 on the 10-year yield. So I really could have saw, and I think a number of people could, Chairman Powell coming out like a hawk, unhappy about that, saying, hey, the next move might be tightening. We don't know. It's all data dependent like they always do. And he kind of didn't. He was pretty balanced today. And I think that's one of the reasons that we got the rally that we did, of saying it's data dependent. It always is. But he also came out and said that policy remains restrictive. And it's accurate. So it's not that, we're going to have a recession so that we need to ease. It's that 5.25 to 5.5 is overly restrictive. So if we're making progress toward our goals of 2% inflation, maybe we can be a little bit less restrictive. I think it's very data dependent. The market now is thinking that we're going to maybe have an easing in March. I don't know. What do the numbers look like in March, right? You tell me what CPI looks like. You tell me what unemployment looks like. Tell me what PCE is. And I can give you an answer, but I don't know any of those things. I don't know if economists do or not. There's a lot of opinions out there about it, right? But so I think the market may have kind of stretched a little too far on expectations for 2024. But the good news is the expectations are no longer that we're descending down the abyss of some sort of hyperinflation. We've got those inflation expectations a little bit back under control.
Rob, do you have one of those 8-ball things that you used to shake that you could like flip over for us? And
you're stealing my thunder for next Friday, Melissa.
I thought of all the toys, like that would be the one that you would have.
Oh, who knows?
That's right. I will ask again later.
Some other good news that the stability is bringing in, though, that at least we're seeing is ARM pricing that actually makes sense. People that can you might have to pay a point or two, but you can actually get an ARM rate that for the first time in a while, at least it's not a bank portfolio or credit union portfolio product, actually can make sense for borrowers. So it feels like we haven't had ARMs be popular in a long time because either fixed rates were so dirt low, everybody wanted a fixed rate, or the yield curve was so inverted and there was so much, tribulation in the market, so much chaos that ARMs just kind of fell apart. Nobody knew what the heck they could be worth because they had no idea what Fed funds were going to look like in 6 months or a year. So that's something that's real good news, I think, for mortgage bankers that's happened in the last 30 to 60 days is that we have ARM pricing that's over par. You may have to pay a little bit in the way of points, but if you can get an ARM for a full 1% less than a 30-year and still have that 30-year AM, I think that's going to be pretty attractive to a number of people.
So, Chris, I think I know the answer to this, but you're far more erudite than I am. Can you hedge ARMs?
Yeah, you can.
Really?
So how do you hedge ARMs? Very carefully. But yes, you can. No, that's the answer, very carefully. For the most part, you want to design something that treats them very similar to a 15-year mortgage-backed security because they move in a much more similar fashion. The only thing you have to be careful about on ARMs is if you're selling them to a cash window and not securities, is that they kind of cap out those max rates. And a lot of people like to take ARMs at the max rates. So you have to be a little bit careful there that you don't have a case where you're hedging ARMs, the market rallies, rates go down, and now your hedge is gone underwater and you're not getting a correspondingly higher price. So you'd have to be a little bit careful about it.
We have time for one more question, but before we get to the last question, I want to let everybody know this obviously is our second day of our conference, the 12 days of TNC. We do this special rundown series. So we have one today, one next Friday, and the one right after that are all part of our 12 Days of TMC conference. If you guys have not registered, we have some really cool things that are a part of that conference, and would love to have you join us. We have a record number of registrants this year. We have, well over 3,000 right now. So it is a very exciting event for us as a whole. We're also doing something unique where we're going to do a solution sprint. I think I've talked about it here a few times, but we're going to solve some of the things that we talked about today: inventory and affordability. And, one thing we didn't talk about is rising costs that lenders are tackling right now as well. And so we've got some fun things we have planned to be able to solve those. And just wanted to say, Vice Capital, thank you so much for your sponsorship, for being a partner of TMC for us, and for giving us your expertise and insights today. And then I'll hand it over to Rob for our last question in the day. Is that okay?
What a setup! I thought you had the last question.
No, I was going to give it to you. I can give a last question if you'd like.
Give it a shot.
Fantastic.
So go ahead.
No, you go.
Chris, what have you always wondered about Melissa? Why don't we?
Good gravy.
Why don't we have that question? No,
I like it.
So Chris, you Vice Capital has a wide range of clients, hedging fixed rates, ARMs, and so forth. Frankly, for me, I am tired of hearing the survive until 25 mantra. I don't like that. There are plenty of companies that in 2024 will be going after the market share of those companies who have the mentality of survive until 25. Are you seeing among your clients a pickup in volume and or a reason for kind of a reason for optimism, or sales having been trimmed to the point where they're at least break even, if not in the black, as we head into the last month of this year and into early 2024? Are you seeing some green shoots out there?
Yeah, I think so. I think there's been a number of things. MBA's purchase index is up, I think, 4 weeks in a row now. Spreads have come in, ARMs exist. We're seeing people be more creative. And I agree with you. The whole idea of survive till 25, I don't think that makes any sense. If you're going to kind of line a business that you just decide to pull out, then I guess that's your prerogative. But like you said, I think there's a lot of market share to be grabbed out there. And you've got to make sure, and hopefully you have by now made sure that in the current environment, how can you at least break even, if not eke out a small profit, right? And if you haven't figured that out, you better figure it out pretty gosh darn quick before your capital all goes away. But that aside, we're seeing, I'd say in the last probably 4 to 6 months, especially, people deciding to be a lot more creative, and not just think that, oh, well, there's no inventory out there and refinances don't exist, so I don't have anything to do. Maybe I'll start making some wicker chairs. There's, you've got a whole giant database as an originator of all these people that you've served. Reach out to them. It doesn't mean you're reaching out and say, hey, you want to buy a house, but if you've got the time, make those contacts. You never know how many people, and we see a good amount of it, how many people have spent a lot in the last 12 months and 24 months. They've got themselves in a bit of a pickle. And even though they might be trading a 3% mortgage for a 6% mortgage, you can do something for them that lowers their monthly payment by $1,000 a month. And that's what they care about, is the cash flow aspect of it. And somebody's going to go meet those needs. Why not you? They're your customer. Just check in with them. If you've got the time, do it. Things like builder forwards, those have been around for a long time. But now they seem to matter more. Now it's a case of people still have such sticker shock about the payments. If you can get something together that involves paying some points, and you can advertise a home for $5.99, even like you can almost do the opposite of a lock-in shop. We've heard people chat with us about instead of saying to a prospective buyer, hey, you can lock this rate and go buy a house, do the opposite for a seller, right? You can say, hey, what if you're willing to pony up X amount of money, you can advertise this house that comes with an X% interest rate with these caveats to it. And if you don't mind paying those discount points to get it, now you've got a lot more interested buyers in your house that wanted to buy your house, but the payment just doesn't work for them at all. So, and not that there's a whole lot of that going on, but it's just good ways to kind of be creative. Well, we have a small amount of volume out there. What can you do as an originator to stand out to realtors, to builders, to other kind of partners of yours of, we're not all the same. Here's what I can do for you. And I think companies that are able to do that are the companies that they're going to thrive and not have to wait till 25, but they can have a pretty good 24 too.
It is. We've gotten some fun comments in the chat. So, survive till 25. They say get more in 24.
I like that one.
And then thrive in 25. So open doors in 24 too. Yeah. So lots of really fun things coming through the chat. I love it. I totally agree that the survive till 25 is, I might be a little limiting to what's possible in the marketplace for sure. All right. Well, we are all up on time. Chris, thank you so much for joining us. Rob, thank you so much for joining us as always. Everybody, thank you for spending your Friday afternoon with us and allowing us to have a little bit of fun and share some insights on mortgage at the same time. And to everybody that's here, that's not a part of 12 Days of TMC, get registered. We'd love to have you there. And otherwise, we will see you next